The investing mistake that's slowly making you broke, and you think you're fine. How much money do you have saved and invested right now, not counting your 401k you never look at, just actual money you've consciously put to work? If that number made you cringe. If there was a long pause before you answered. You're not lazy. You're not bad with money. You just accidentally became the worst type of investor without anyone ever telling you. And that type has a name. We're going to talk about it today. Here's what nobody tells you when you get your first real paycheck. The moment you decide not to invest is still a decision. You've just chosen the worst portfolio in history, 100% cash sitting in a savings account, losing roughly 3% of its value every single year to inflation. Silently. Invisibly. While you sleep. There are basically a dozen different ways people invest, or try to invest, in America today. But most financial content presents them like a fun personality quiz. Oh, you're a growth investor. You love risk. You're a dividend investor. You like boring things. That's not useful. What's actually useful is understanding why certain types of investors consistently win over 20 to 30 years. And why others, despite being smart, hardworking people, end up with almost nothing to show for it. So today, we're going through every major investor type. But here's the twist, for each one, I'm going to tell you the hidden cost most people never see coming. The trap buried inside the strategy. By the end of this video, you'll know exactly which type fits your real life, not your fantasy version of yourself, and what to do next. No jargon. No lectures. Just straight talk from someone who wants you to actually win. Let's go. The 4 types that actually build long-term wealth. The set it and forget it investor. This is the most underrated investor on the planet, and most people skip past it because it sounds too simple. Here's what they do: every single paycheck, a fixed amount goes automatically into a low-cost index fund, something that tracks the entire US stock market, like a total market ETF. They don't research individual stocks. They don't try to time the market. They just keep buying, month after month, year after year, rain or shine. Boring. Absolutely. Effective. Shockingly. Here's a real number for you. If a 25-year-old American invests just $400 a month, that's less than most people spend on subscriptions, fast food, and random Amazon purchases combined, into a total market index fund averaging 10% annual returns. By age 65 they'll have over $2.5 million. They didn't pick a single stock. They didn't stay up watching CNBC. They just automated it and lived their life. Warren Buffett, the greatest investor alive, has said publicly and repeatedly that his advice for most regular people is exactly this. Not what he does for a living. A simple index fund, bought consistently, will beat almost every professional money manager over a long enough timeline. The hidden cost. Boredom. That's actually it. The biggest enemy of this strategy isn't the market, it's you panicking and selling when the market drops 20%. If you can sit on your hands during a crash, this strategy is almost bulletproof. The value investor. These are the people who treat the stock market like a clearance rack at a store they love. They're not interested in whatever's hot right now. They want great businesses, real ones with profits, loyal customers, and strong balance sheets, that are selling for way less than they're actually worth. Think of it this way. Imagine your neighbor owns a profitable pizza shop that nets $100,000 a year. Now imagine he's going through a rough patch and needs cash fast. He offers to sell you 10% of that shop for $50,000. That means you're paying $500,000 for a business making $100,000 a year. That's a good deal. Value investors are constantly looking for that kind of gap, between what something is worth and what the market is charging for it. Warren Buffett made his entire fortune doing this. So did Charlie Munger. So did countless less famous investors you'll never see on TV because they're too busy quietly getting rich. The hidden cost. Patience. True value investing requires you to wait. Sometimes years. The market might not agree with you for a long, long time. And during that wait, you'll watch other people making money on stuff that looks insane. That psychological pressure causes most people to give up right before the payoff comes. The growth investor. If value investors are buying what's cheap, growth investors are buying what's fast. They look for companies where revenue is climbing fast, the user base is exploding, and the business is changing an entire industry. They're willing to pay more today because they believe the company will be worth dramatically more in 5 to 10 years. Think about what it would have felt like to buy Amazon stock in 2003 when it was still mostly a bookstore. Or Netflix in 2010 when Blockbuster was still laughing at them. Growth investors saw the trajectory before the rest of the world caught on. The returns can be jaw-dropping. But so can the losses. The hidden cost. Valuation blindness. When a company is growing like crazy, it's easy to overpay. And if that growth ever slows down even slightly, the stock can get crushed by 40, 50, even 70% almost overnight. Many people who bought great growth companies at the peak of 2021 are still waiting to break even. The dividend investor. This one is for the people who want their money to pay them on a schedule, like a second job that never calls in sick. Dividend investors buy stocks in companies that distribute a portion of their profits to shareholders, usually every quarter. Think utilities, consumer staples brands, banks, healthcare giants. These aren't exciting businesses. They're just incredibly stable ones. Here's why this matters for regular Americans. Let's say you slowly build up a dividend portfolio worth $300,000, averaging a 4% yield. That's $12,000 a year hitting your brokerage account. About $1,000 a month. Not enough to retire on alone, but completely passive. And if you reinvest those dividends while you're still working, your portfolio compounds dramatically faster. The best dividend investors focus on companies called dividend aristocrats, businesses that have raised their dividend every single year for at least 25 consecutive years. That's a list that includes names like Coca-Cola, Johnson & Johnson, and Procter & Gamble. These aren't get-rich-quick stocks. They're get-wealthy-slowly machines. The hidden cost. Opportunity cost. During a big bull market, dividend stocks can lag behind growth stocks significantly. If you're young, putting everything into boring dividend payers might mean you're leaving serious gains on the table. Most financial planners suggest blending this approach with growth exposure, especially before age 50. The 4 types that are really just gambling in a suit. The momentum trader. Here's one that looks like investing but usually isn't. Momentum traders buy what's already going up, fast. The logic is, if something is moving, ride the wave until it stops. No deep analysis. No business fundamentals. Just price action and charts. And sometimes it works spectacularly. Nvidia in 2023. Tesla in 2020. Certain crypto coins in 2021. If you caught those waves at the right time, you made eye-watering money. But here's what the highlight reel doesn't show you. Studies consistently find that the majority of active traders, even professionals, underperform a simple index fund over 10 to 15 years. Not because they're dumb. Because markets are unpredictable enough that even a strategy with a real edge gets destroyed by the costs of constantly buying and selling, taxes, trading fees, and the emotional toll of riding wild swings. The moment you're checking your portfolio more than once a day, you've stopped investing and started gambling with extra steps. The hidden cost. Time and taxes. Every trade is a taxable event. Every decision costs mental energy. Most momentum traders find themselves exhausted, stressed, and no richer than they would have been just buying an index fund and going outside. Let's be completely honest about this one. Day traders try to profit from tiny price movements in stocks, sometimes making dozens of trades in a single session. They watch candle charts, volume spikes, and technical patterns. They love the action. They love the control. Here's a sobering fact from a peer-reviewed study of day traders in Brazil, one of the most rigorous studies ever done on this topic. Of all the people who day traded for more than 300 days, only 3% made money. 3%. And most of those barely beat a basic savings account after expenses. And yet it looks so attractive from the outside. The guy on social media with the laptop on the beach, posting his $15,000 day. What they don't show is the 10 days before that where they lost $20,000. Or that most of their actual income comes from selling courses to people who want to learn what they're doing. If you want the thrill of picking individual stocks, fine, allocate a small, play money account to it, 5 to 10% of your total portfolio. Go nuts. But don't bet your financial future on it. The hidden cost. False confidence. The market gives beginners what traders call beginner's luck, a few early wins that convince you you've figured it out. Then the real market introduces itself. This is the financial equivalent of adding a turbocharger to a car you barely know how to drive. Options are contracts that let you control large amounts of stock with a small amount of money. Get the direction right, and your returns can be 300, 400, even 1000% in days. Get it wrong, and your entire position expires worthless. It has a literal expiration date, like milk. Michael Burry from The Big Short famously used a form of options to bet against the housing market in 2007 and made billions. But Michael Burry spent years doing forensic accounting on thousands of mortgage documents before placing that trade. He had information and conviction that most people will never have access to. For the average person, options trading is a way to lose money faster than almost any other legal financial activity. The data on retail options traders is brutal. The hidden cost. The complexity is the trap. It feels sophisticated. It has its own vocabulary, its own culture, its own Reddit forums. That vocabulary makes people feel like experts before they've earned the right to feel that way. The crypto speculator. This one is genuinely complicated, so let's be fair. Bitcoin and Ethereum are real assets now. They have real ETFs, real institutional investors, and real government recognition in multiple countries. Treating them exactly like tulip bulbs in 1637 is intellectually lazy at this point. But here's what's also true. The crypto market is still overwhelmingly driven by speculation, leverage, and social media hype. For every person who bought Bitcoin in 2020 and tripled their money, there's someone who bought a random altcoin in 2021 and lost 95% when the project disappeared overnight. The honest position for most Americans, a tiny allocation, 2 to 5% of your portfolio max, to Bitcoin specifically isn't crazy. It has enough history, institutional backing, and legal infrastructure that it's at least a speculative asset with some floor. Everything else in the crypto universe should be treated like a lottery ticket. Fun, maybe. A retirement strategy, absolutely not. The hidden cost. Emotional volatility. Crypto moves 20% in a week, up or down. Most people cannot psychologically handle that without making terrible decisions at the worst possible time. The three specialty types, real estate, gold, ESG, angel. The real estate investor. This is the one that sounds the most like real investing to most Americans, probably because your parents told you to buy a house. Real estate investors build wealth by owning physical properties, single-family rentals, duplexes, apartment buildings, and collecting rent while the property appreciates over time. The secret weapon is leverage. You put 20% down, the bank covers the other 80%, and your tenant's rent slowly pays off the entire mortgage. Done right, it can be one of the most powerful wealth-building tools available to regular people. The problem is what the Instagram, passive income, crowd never tells you. Real estate is not passive. A tenant stops paying rent in January, calls you about a broken furnace in February, and leaves a total disaster behind in March. You're dealing with maintenance, insurance, property taxes, vacancies, legal disputes, and the occasional nightmare tenant who knows exactly how to game the eviction process in your state. That said, real estate millionaires are everywhere in America. The path is real. It's just more of a business than most people expect. The hidden cost. Illiquidity. If the stock market crashes and you need money, you can sell shares in 10 seconds. If real estate crashes and you need money, you're stuck. You can't sell half a house. The gold bug. Gold has been money for 5,000 years. That fact is emotionally compelling, and it's why a certain type of person holds gold like a religion. But here's what the history books show you when you zoom out. From 1980 to 1999, nearly 2 full decades, gold went from around $670 an ounce all the way down to around $256. An investor who went all in on gold in 1980 didn't just see slow growth. They watched their wealth get cut by more than 60% in nominal terms. After inflation, the damage was even worse. Meanwhile, the stock market multiplied by more than 10 times over that same period. Gold isn't worthless. A small allocation, some advisors suggest 5 to 10%, can act as a hedge during genuine financial chaos. But treating it as your primary wealth-building tool is like buying car insurance but refusing to drive anywhere. You're protected, but you're not going anywhere. ESG stands for environmental, social, and governance. These investors specifically choose companies that meet certain ethical standards: clean energy, fair labor practices, diverse leadership, transparent accounting. There's nothing wrong with this in principle. Your values should absolutely inform your choices. But be clear-eyed about the trade-offs. In 2020 and 2021, ESG funds did phenomenally well, largely because tech stocks, which score high on ESG metrics, were on fire. In 2022 and 2023, when energy prices spiked and dirty sectors surged, ESG funds lagged the broader market significantly. That doesn't make ESG investing bad. It makes it something you should choose consciously, knowing that sometimes doing good and doing well don't happen at the same time. So which type should you actually be? Here's what most financial videos won't tell you, because it's not glamorous enough for a thumbnail. The answer is almost never just one type. The most financially successful regular Americans, not hedge fund managers, not venture capitalists, just people with $1 to $3 million in real net worth by retirement, typically run what you could call a core and explore portfolio. The core, usually 70 to 80% of everything, is boring. Total market index funds. Maybe some dividend payers. Set up on automatic. Never touched. Never timed. Never panicked out of. The explore, maybe 10 to 20%, is where personality comes in. Maybe a handful of individual stocks they believe in. Maybe a real estate investment. Maybe even a sliver of crypto if they can sleep at night. And the rest. An emergency fund in a high-yield savings account, because the greatest enemy of a long-term investment strategy is being forced to sell when the market is down because your car broke down and you have no cash. Here's the real framework to figure out your type. Step 1. Ask yourself your actual time horizon. Money you need in 5 years or less should not be in stocks. Period. That's not investing, that's gambling with rent money. Step 2. Be honest about your emotional tolerance. Can you watch a $50,000 portfolio drop to $32,000 in 3 months and not sell? If the answer is no, you need more bonds or stability in your mix. There's no shame in that. Selling at the bottom because you panicked is the single most destructive financial mistake regular investors make. Step 3. Automate before you have time to second-guess yourself. Set up an automatic contribution to an index fund for the day after your paycheck lands. Make the decision once. Remove yourself from the equation. Step 4. Ignore almost everything you see about investing on social media. The people making money don't need your attention. The people selling courses do. The unsexy truth is this: a person who earns an average salary, lives below their means, and automatically invests in index funds for 30 years will almost certainly end up wealthier than the person who spends those same 30 years trying to be clever about it. Wealth isn't built by finding the perfect strategy. It's built by picking a good enough strategy and having the discipline to stick with it when your emotions are screaming at you to quit. So here's your homework, and I mean actually do this today, not someday. Open your brokerage app, or open one if you don't have one yet, and look at where your money is sitting. Is it doing something, or is it just waiting in cash while inflation quietly eats it alive? If you're not sure where to start, the comments are open. Drop your situation and I'll point you toward the right video. And if this gave you any kind of clarity, even just one thing, hit that like button and subscribe. We put out real, no-nonsense personal finance content every week. No hype, no gimmicks. Just the stuff that actually moves the needle. I'll see you in the next one.